morning and welcome to your Monday, September 2nd market news update. Dow Jones 30 locked in its fourth straight month of gains as fund managers dilute their tech-based holdings. Gold extends its pullback near the $2,500 area, feeling the pressure of the stronger dollar. Lockheed Martin secures another army contract modification worth $3.4 billion. China's manufacturing activity contracted further in August, confirming worries of investors. Declines in deliveries of NIO could jeopardize market sentiment ahead of its earnings release. Data update from the Fed's fifth gauge of inflation, the Core PCE index aligned with market expectations for upcoming cuts. Finally, Euro attempts to snap its three-day losing streak as the rise of the beaten dollar takes a pause. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 2nd of September of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. The first topic of conversation is going to be about the Chinese manufacturing activity, which has continued to disappoint yet again. So on early Saturday morning, we saw China's National Bureau of Statistics releasing the latest and updated PMI data for both the manufacturing and services activity of the Red Dragon for the month of August. And we have seen mixed results, which partly disappointed investors and traders yet again. So the data indicated that the nation's services sector activity avoided a deceleration, and on the contrary, it expanded at a faster pace than originally expected by economists. And we have seen this August meeting being this August as a month being the 20th consecutive month of expansion in the services industry of China, which is obviously a very nice thing. So on the flip side, however, we have seen manufacturing activity shrinking in the most in 6 months, setting it back to levels last seen before in February of 2024, so 6 months lows, if you would like, and has put in jeopardy the end of the highly anticipated recovery progress of China. So weighing down the PMI reading were contractions in new orders, weakening employment trends, but also stalling foreign sales. And we have talked about a lot about the potential impact of tariffs that are going to be imposed on Chinese exports by Western nations. This is definitely going to impact the trade data, but also the PMI activity of the Chinese economy in the months to come. At least that's the expectation. Now, since manufacturing is the key core GDP contributor of the nation's growth, since we know that Chinese economy is indeed a manufacturing powerhouse, investors still feel unease and await the announcement of further policy measures, of looser policy measures by authorities in order to feel confident enough to start allocating funds in the Chinese economy and capitalize upon growth. And speaking about growth, GDP, China's growth estimates from top investment banks and investment funds and all that kind of stuff range between 4.5% and 5% for the current year, which is at the end of the day an exceptionally higher number compared to, or percentage compared to other major economies, more exactly the G7 nations. For some reason, portfolio managers need to see more from the world's second largest economy before allocating capital and funds into domestic operations, as the nation is indeed struggling with a beaten down real estate sector, suppressed domestic demand and consumption, but also, as we just saw today, stagnating manufacturing growth activity. Okay, so that's all from China. Mixed results. We'll see how the Chinese authorities are gonna respond to this piece of data, whether we're going to have some looser also financial conditions and slashing of more rates by the PBOC, for example, in the MLF rates or any other given rate to be in. But yeah, for the time being, we're going to keep it here in regards to China. Let's move on to the next topic of conversation, which is going to be a week ahead kind of outlook on what to expect, since today we don't have any major economic news releases. So making a start on Tuesday, we know Switzerland's inflation update, definitely going to be important, but also the ISM manufacturing PMI update from the United States for the month of August. Also a piece of data that's going to be intriguing, to say the least, and we're going to definitely look upon these kind of results from the US. Hopefully it's going to give us clues as to how the US economy is actually behaving on the manufacturing front, and whether the procedures or protocols or let's just say outlined path from the US government in order to boost up the manufacturing industry of the United States in order to compete with powerhouses and fronts abroad is coming in, and how they are actually behaving, if there is enough fixed asset investment in these kind of areas in order to re-establish the United States as a industrial powerhouse or a manufacturing powerhouse. We will see, depending on the data. Now on Wednesday, on a data-packed Wednesday, we highlight Australia's GDP print for the second quarter of 2024 is going to be the final print, and also China's Taixing services PMI data in the early Asian session. Also, we're going to have the latest jobs openings report and update from the United States in a employment-driven kind of week. But also the main event of the day of Wednesday, the Bank of Canada's interest rate decision for their September meeting. Now, on Thursday, we know the ADP non-farm employment change, the weekly initial jobless claims, but also the ISM services PMI, the non-manufacturing PMI update from the United States. All critical data. We have two on the employment front and one on the services front. We will see how the US fares amidst this kind of period right now. And finally, Friday, we close the show with fireworks, as we're gonna get the non-farm payrolls report for the month of, not June, but for August, which is going to be released, but also the final GDP print from Eurozone for the second quarter of 2024. So final GDP for the EU, also something we will be paying close attention to, but without a shadow of the doubt, the main event of the week is the NFP print after the panic scare we have seen with July's report, which was released earlier in the first week of August, which scared the markets and pushed, in a sense, equity traders more specifically to unwind their positions and start sizing down their portfolios in fears that this crackdown of these cracks that arose within the employment market of the United States are foretelling that possibly a recession is going to be on the horizon. Okay, further data is needed upon this kind of bet to make it valid or not. So Friday, we're going to get a subsequent NFP print to see whether the job growth function of the United States is remaining robust or additional cracks are coming up. So that's the end of today's session, guys. Thanks for watching, and we will catch you on to tomorrow's session for hopefully another brief update. For the time being, we're going to keep it here. Thanks for watching. Take care and bye.
We're gonna do today's presentation pretty briskly and quickly together. So now let's dive into technical analysis and candlesticks. Okay, this was in a sense the scheduled webinar for the day. Let's dive right in without any further ado. So risk warning and disclaimer, you can read it at your own time. Give me 1 second, guys. I have to adjust my screen accordingly. So, this is the agenda for today's session. Moving past fundamental analysis, going into technical analysis, we're going to do candlesticks, intro to candlesticks, super basics. Again, we're going to elaborate and go deeper as we progress through time. This is for introductory purposes only, okay? Don't expect to see any crazy, difficult kind of material coming out from this. This is briefly an introduction, okay? So hopefully we're going to cover the basics, and there we're going to build upon our knowledge as we go deeper into this kind of topic, okay? So agenda A is introduction to candlesticks, bullish and bearish candles, wicks and shadows. At the end of the day, what we care about is interpreting correctly what individual candles are telling us, and we're going to visit a few candlestick formations. Sorry guys, my nose is stuffy. Let's go. So, a brief history of candlesticks. Candlesticks, in a sense, originated in Japan back in the 17th century from a Japanese merchant called Homa, okay, which discovered that despite the connection between the price of rice, the price is there, and its supply and demand, the markets were more influenced by the emotions of traders. So this guy observed something back in the 17th century, which gave rise to what we call today candlestick formation, and therefore candlestick trading. And in a sense, this is a depiction or a visual interpretation of not only supply and demand forces, but also emotions of traders. And if you have understood or at least got a glimpse of what technical analysis is, it's not merely about supply and demand. It has also a psychological aspect to it, which is what we are attempting to do as technical traders or technical analysts. Okay, so this technical analysis has origins back in Japan of the 17th century. That's essentially what you need to remember. Okay, for entertainment purposes only. You can brand this as useless tip of the day, but still, let's pay homage. Let's pay homage to the guy that discovered the whole thing. So it is likely, however, that Homer's original ideas were modified and refined over many years of trading, eventually resulting to the system of candlestick charting we use today. Okay, so influences go back then. We have refined and we have upgraded and optimized these kind of rules, if you will like, or principles, and we use them into today's day and age in order to make money in financial markets. Okay, so if you have not seen candlestick chart before, this is it. So it's a visual illustration of a candlestick chart. You're gonna go over each and every nitty-gritty detail on the formation of individual candles. If you understand how those are created, what kind of information they convey, you're gonna start putting candles together, bundle them together, and interpret what they are telling you. They're telling you a story, and once you start understanding how the story is being told, you can, in a sense, not foresee, but you're going to have a higher chance or probability of placing a correct trade and making money upon it once and only if you understand what information is conveyed. Let's do this. So, bearish and bullish candles. I think in the past, in the introduction of technical analysis, we have mentioned how candlesticks are being formed. Let's do a small recap. So you have what we call bearish and bullish candles. So the bullish candles are primarily being depicted in the color of green. You can change the color, you can put it whatever you want, doesn't matter. The point is to understand what information is conveyed. On the flip side, you have bearish candles that are represented in red. Once again, you can paint these candles in whatever color you would like. You can do them purple and yellow, whatever that is, doesn't matter. The point is to understand the information conveyed. I'm repeating myself. So in order to have a bullish candle, what we call a bullish candle, represented in green in this kind of case, the close price, get my pen, whatever that is, pen, yeah. So the close price is always higher than the open price. So irrespective of the color of the candle, if the open price, or in other words, if the open price is lower than the close price, or the close price is higher than the open price, this is a bullish candle. Okay, so in a sense, what we call a bullish candle or a big white candle, which was used back in the day, black and white candles, before we go into the colors. That's why I'm saying colors are inconsequential. We don't really care about the color. We care about what information they convey. It was the bullish candle has an unusually long white body. The body is this. Okay, this is what we call a wick. Okay, so open, close price. This is a bullish candle. Sorry about the gibberish. Okay, so it has an unusually long white body with a wide range. This is the range. Close price with the open. Okay, big range. Okay, between high and low of the day. This is the high. We're talking about this lovely peak here of the wick, that thread you can see below and above the full body. This is the low. Okay, so indicates that the price action has given rise within this kind of period. Okay, so that means there is strong bullish sentiment. Okay, that's why we call them bullish. That means people are eager to push prices to higher ground, meaning that for some reason, whatever that reason is, they foresee they in their assessments that specific instrument is underpriced and needs to they feel the need to adjust the price by raising it to reflect its current market value. Okay, sorry for the technical talk, but yeah, that's how you interpret this. So when prices open near the low and close near the high, we consider this as bullish because of what? People are willing to buy whatever that instrument is at a higher price with a conviction, which creates this candle. That means there's super high demand for this specific instrument at that point in time. Okay, that's why we call this bullish. Okay, on the flip side, a bearish candle, okay, has an open which is higher than the close price, or in other words, a close price lower than the open price. This is the difference. Okay, so irrespective of the color, you see what the candle is telling you by studying open and close prices. Okay, so when you have a candle that has an unusually black long body or red long body with a wide range between high and low, this, okay, and this as well, this is what we call a bearish candle. So up prices open near the high up there and close near the low down there. That it means that has strong selling pressure. People are leaving behind this instrument. They are pushing its price to lower ground because they believe that at that point in time, that specific instrument, that specific asset, whatever that is, if it's gold, if it's crude oil, if it's FX pair, whatever that is, they feel that at this point in time, it's overvalued and therefore you need to sell it in order to find its current market value, which reflects new information. Okay, this is an adjustment by the market. Okay, so when you have big red candles, you have an adjustment, a bearish adjustment, a selling adjustment, a strong selling tendency of that specific instrument at that specific point in time, because it's, if you would like to conceptualize this, is overpriced. Whereas if you see a big green candle with prices rising, okay, with strong bullish demand, that means that that specific instrument at that specific point in time is undervalued, and therefore the market rushes in to price it at the correct value, which is higher than originally was at the start of that period. That's it. Moving on. Candlesticks formation. Okay. So formation of candlesticks. Let's see what information is within this slide. So a candlestick is formed with the help of opening. Sorry. How can you delete this? Sorry for smudging the whole thing. So you have four main components for each and every candle. Okay. So it has an open price, a high price, a low price, and a close price. Those are the four elements that are conveyed for every candlestick out there. Sorry, this one. Okay. You have, if you study each and every one of these candles, whatever the ones you're going to study, okay, each and every one of them has these four main components. High, okay, this is the high, this is the low price, this is the open price because it's a red candle, okay, and this is the close price, okay. So these are the four components that make, in a sense, these kind of candles, okay, and we will study each of these components much more specifically and the candle by itself and understand what information it conveys. So if the open price is above the closing price, then a candle is filled, okay, and is drawn down. That means it gets a color, okay. Normally a black color or red color, okay, let's keep that in mind, is used for filling the candle, okay. So if the open price is above the closing price, so if open is here and close is here, that is a bearish candle, okay. Without colors, you know what it is, okay, because it tells you open price is higher than the close price. On the flip side, if the closing price is above the open price, it's a white candlestick, or what we call green, or a bullish candle, okay. So what it says is here, this is the close price, this is the open price. So prices opened here, moved there, moved to the upside, candle is painted green, No surprises there. So the field option of the candle is a body of real body. The field portion of the candle is known as the body of the real body. Okay, just for you to keep in the back of your mind, which can be long, normal, short, with proportionate to the line above or below it. So how big the candle is, the body of the candle is, gives you different indications. You will see them shortly. And the lines, either long or short, these lines, okay? Below and above the real body represent the high and low price range. We mentioned this and are known as shadows, tails, or wicks. You can find these kind of common, what do you call it? Lexicon? Definitions, or at least names, or slang, if you would like, for this kind of high and low points as shadows, tails, or wicks, irrespective of what they are. They convey the same information. We're talking about the highest or, the lowest or the highest point that price action have reached within that specific point in time. Okay, for a particular day or any time frame you choose, the highest price is declared as the top or the upper shadow, this level, and the lowest point is marked by the bottom, which is the lower tail, or the lower shadow, which is this point here. Okay, so please know that the body may or not have shadows, tails, or wicks. So you can have a candle like this, okay, or you can have a candlestick like this. Okay, these candlesticks have different names. We will see them shortly. Okay, so this is another way of visualizing candlesticks. Again, closing price is higher than the open price. Okay, so prices open there and they move up there, bullish. Okay, open is up there, closes down there, prices move downwards, bearish. Simple enough. We've seen this. Moving on. So another visualization. And we're going to do a comparison between the real body. Real body is this. Okay, no excluding the shadows, this and this. Okay, this is the real body. Okay, so what can you observe from these two together, this versus this? What conclusions can you come up with? Okay, so a candle that has a big real body, okay, much like the one we have here, okay, means that there is strong demand, okay, strong bullish pressure, okay, strong buying pressure. Whereas a body that has a smaller, okay, real body compared to this, okay, has, comparatively speaking or relatively speaking, weaker buying pressure. Obviously, if you compare the two, okay. So the longer or the bigger the real body of the candle is, okay, the much stronger, okay, the bulls are eager to push the price action to high ground. And once you see big green candles, okay, with or without tails, that gives you an indication, you know what, they are eager to push price action into higher ground. There is strong bullish tendencies here. Therefore, you can, even though it's not advised, to go on and open a long position without taking any other information in, which is not optimal. Okay, you can get, in a sense, a signal that, you know what, maybe price action is going to continue moving to high ground. Therefore, I'm willing to participate. And once I see these big green candles dwarfing prior candles, I'm going to go long and buy this, whatever that instrument is, and capitalize on the expectation that the price action is going to move to high ground. Okay, that's how traders behave in general. Okay, so on the flip side, when you have a real body, that is, make the same comparison here as well. It's the same thing. Okay, obviously the flip side, when you have big red candles, you can extrapolate there is strong selling pressure. Okay, if compared to this, obviously, which has a smaller body, which signals weak selling pressure. Therefore, if you see this green candle coming after, for example, these two together, okay, that gives you an indication the bears are eager to push prices to lower ground. Therefore, you anticipate that the Price action is going to extend towards lower ground, okay, and capitalize. You want to capitalize on the falling of prices, therefore you go short, okay. Long means buying, short means selling, and you can do that with derivatives or future contracts, whatever you can call them, for any given instrument in the platform, okay. Either it's going to be FX pair, it's going to be commodity, it's going to be for example, an equity, going to be an index, whatever that is. You can do that accordingly. If you see prices falling and you deem good, that is a nice entry point for a short, you go short. If you see this big red candle, if you happen to see a big green candle after, depending on where it came from, actually, okay, we're going to see that. Indicates strong bullish pressure, strong buying pressure. Therefore, you go long, you buy, and you capitalize on the upside. Okay, this is a crude way of looking at things. It's not advised to look at individual candles and basing your strategy upon them. You can use them in accordance with other stuff to confirm your biases, and then go ahead and buy or sell whatever that is. Individual candles bear no kind of significance and under normal circumstances, but there are exceptions that they actually do serve purpose, a powerful purpose that we will see in this, hopefully this webinar or the ones that will come. So wicks and shadows, they convey information as well, and you can see that clearly from these illustrations here. Okay, so there's several ways to interpret this kind of movement. It's a green candle, therefore that means that the open price is here and the close price is here, but we do not know what has happened within the day. For example, price action might have opened here, moved, okay, down to hit the lowest low, the lowest point in the day, which is this, okay, and then they might have rebounded and done this, okay, hit the high, and then come back down here and close the day. Okay. Therefore, this, in a sense, gives us an indication of what our buyers and sellers are doing within the day. Okay. So, in a sense, you can interpret this kind of candle that has a long upper wick, okay, or shadow, whatever that is. Okay. Buyers as buyers taking initially control, but afterwards, sellers forcing the price action to lower ground near where it has opened. Okay, so you see a small trading range. Okay, so that once again, if you go back to the price slide, that means a weaker a weaker buying pressure. Okay, fresh. I'm not going to write the whole thing. My handwriting is terrible. Okay, whereas on the flip side, okay, let's study this. You can extrapolate. Let's do the open and close. So if it's a red candle, that means the open was up there and the close was down here. But once again, we don't know what has happened within the day, but we can extrapolate, okay, that this actually did happen. So open price is here. The price has moved to lower ground, okay? So initially, sellers take control. My days, why am I erasing the whole thing? Sorry, boys. So the sellers initially took control, but the buyers were quickly pushing them back on their heels, forcing the price action to higher ground and the closing of that specific period at that level close to the open. Okay, so that indicates weak sell pressure. Okay. Okay, I'm not going to write any further. Okay, so wicks and real bodies give you different kind of clues, so you need to understand how to interpret them. Give me 1 second, guys. We have a question from Elias. Thanks for sharing your knowledge and experience. You can get these PowerPoint slides you have used also where the clips or webinars stored. Okay. Unfortunately, Elias, we cannot provide you with the actual slides. Okay. But if you want to review this kind of material, you can go on the website. You can find the prior webinars are stored there. And if I'm not mistaken, we have opened up a new channel in what is it called? Daily Mail, if I'm not mistaken. where you can use and you can view at your own discretion all this kind of information we have covered in the past in regards to webinars, online for free for you at your own time, at your own pace to go over this and learn it. Okay, review it if you like. However, we cannot provide you with the actual slides, unfortunately, due to legal constraints from the department upstairs. Okay, so can't do much about that. Sorry, guys. So yeah, let's move on. Hopefully, I covered your inquiry, Elias. Okay, so let's move on to the next topic because we're way past our time. So interpreting individual candles, we have done so kind of briskly over the past few slides. Let's move on to other candles that can be interpreted, okay, and gives us valuable information. Such one of those is the doji candle, okay? So the doji is commonly found pattern, okay, or candlestick by itself in the candlestick chart of instruments, okay? So it's characterized by being small in length, okay? That depends. You can see big ones. I've seen quite a few, to be honest. Meaning a small trading range within an opening and closing price that are virtually equal. Sorry, I misinterpreted that. So this is what this point is referring to. So once you have what we call a doji or a cross, okay, as you can clearly see, obviously it's a cross. Open price and close price, open and close, are virtually at the same point, okay, at the same price, okay, but you have seen price action fluctuating within the day, given that you have a high here and a low here. So what information does it tells you? Okay, this candle in a sense by itself is the definition of indecision. That means the open price is here and closing price is here. Price action moved to higher ground, then it came to lower ground, okay, forming a high and a low, and at the end of the day it has closed at the same time, okay? So there is an equal balance between buyers and sellers within that specific point in time. So there is indecision of who is going to take the initiative and push price action to high ground or to low ground. So that signals a crucial pivot point sorry guys, give me 1 sec. It represents indecision in the market, and you can imagine this as a game of tug of war. If you know what a tug of war game is, in a sense, you have two teams, the Bulls and the Bears, and you have a rope, okay, and you mark a line on the ground, and you see two teams fighting each other. So one is pulling the other one towards that line in the middle, which is the threshold, and the other one is fighting back and drawing with their own strength back, okay? So a doji candle is in a sense a game of tug of war that ended with a tie, okay? So no one of the two has won, even though they have gained some ground at the start and then lost that ground by the end of that specific time frame, or at the end of that game, if you would like. Okay, so this is in a sense how you can memorize what a doji is. Okay, so it's a game of tug of war between two forces, the Bulls and the Bears, that have ended that specific point in time with no virtual change, or nobody of the two won. And that's why we brand these candles, the doji candles, as candles representing indecision in the market. Okay, so something else to keep an eye out is that my nose is killing me. Something else to note is that a doji is not as significant if the market is not clearly trending. So if you are in a close trading range, okay, so the market is not, or in a sideways price action, and that means the price action is fluctuating near two bounds for an extended period of time. If you find doji candles in that range, okay, they are insignificant because they're telling you what you already know. Their price action is moving in a sideways fashion within 2 bounds. There's no direction. Doji candles are critical when you have uptrends or downtrends, when they can be found at the end, okay, at the bottoming phases, or at the uptrend at the end of an uptrend, okay, at the topping phases. So at the end of bottoming or tops, if you find dojis, they are super, super, super important because they convey this information, okay? Which the information is the bulls and the bears have found equilibrium, and therefore from there onwards, we might possibly see a reversal, okay? So if, for example, they are moving to lower ground, okay, and you find a doji candle at the bottom of the price action, that is an early indication. You have to wait for the next candle for a confirmation. That doji candle by itself is an indication that, you know what, the movement downwards has halted because you will have found equilibrium between the bulls and the bears. The next candle will decide whether the price action is gonna revert or rebound to higher ground, or whether we're gonna see an extension to lower ground. So it's crucial to wait for the candle, to see the candle next to the doji before entering the market. Okay, so in order for you to avoid unnecessary losses. So if and only if, for example, we're going to see them on the next slide, if I'm not mistaken, a shooting star and the morning star and an evening star, okay? If you see a doji candle on a downward trend, okay, ending in a sense the movement, and you see the doji, okay, and you see the next candle being green, okay, so the bulls have taken control, that is an indication, an early indication that we're going to see a rebound, okay? So a reversal of the prior downwards movement, and we're probably going to see price action moving to higher ground. Again, that in and of itself, it's something, but it shall not be taken as written in stone, okay? So we await to see further validations before we enter the market, okay? So what have we left behind? A doji is not as significant if the market is not clearly trending. Okay, no clear direction can be detected. Okay, as non-trending markets are inherently indicative of indecision. Yeah, we mentioned this. Sorry. So if the doji forms in an uptrend or a downtrend, this is exactly what I just commented. Anyways, this is normally seen as significant. And as it is a signal that the buyers are losing conviction, if that's in an uptrend, when formed in an and a signal that sellers are losing conviction if seen in a downtrend. Okay, pretty self-explanatory, or pretty mansplained by me. Okay, so they have two types of dojis. Hopefully, you can detect the difference. So this one has not extreme, that does not have extreme high and low points. This is L. This is H, indicating high and low. Open and close are here. So prices open and close at the same level. Okay. Whereas this kind of candle compared to this has higher points and a lower low. Okay. So you see at the level they are actually drawn. Okay, so what this indicates is, relatively speaking, super simple. So when you have a long-legged doji, that means has extreme high and low points, but it opens and closes at the same time, at the same price, excuse me. The doji reflects great amount of indecision. So the larger it is, the more significant it is. And larger the high and low prices, obviously. Okay, so it has greater indecision about the future direction of the underlying market. Okay, so we need to see what comes after it, because this is what we call an equilibrium. I'm not going to write the whole thing. EQ, equilibrium. Okay, so a neutral doji, which has, relatively speaking, reasonable high and low points, but open and close at the same time. So a basic bland doji or a neutral doji form when the opening and the closing prices are virtually equal. Yeah, that's pretty much the definition of a doji. Okay, alone dojis are neutral patterns, excuse me. And remember, they do not bear any sort of significance if it is found in a market that moves in this kind of fashion. Okay, in a sideways fashion between these two bounds. If it's in an uptrend and you see a doji, significant. If it's in a downtrend, you see a doji, again, significant. Obviously, depending on what's going to happen next. Okay, so 1 or 2 candles afterwards is essential for you to place a trade with high probability of success. Okay, I'm not gonna stop stressing this fact. You're gonna hear me saying this, making this kind of distinction throughout this series going forward. The importance of adding more stuff to your chart for validation purposes and coming up with a high degree of chance of making profitable strategy. Okay, setting up profitable strategy. Okay, so moving on, we have what we call gravestone doji and a dragonfly doji. Obviously, you can clearly see it by yourself, completely opposite or flipped on its head. Okay, so let's study the gravestone doji first. So it is formed when the opening and closing prices are at the lowest of the day. So you have this, you have here 3 of the 4 main components bundled together. You will see what I mean by this component. Anyway, enough. I have patience for this today. So you have open here, you have close here because it's flat, okay, no real body, and you have the low as well. So the Lone Ranger is the high point, which is this one, okay? So you have 3 out of 4 components of what makes a candlestick, okay, at the same level. This is the gravestone doji at the same, with the same token, the same shit is with the open, the close, but the high point for a dragonfly doji and the lower point is by itself a rogue one down there. Okay, so gravestone doji is formed when the opening and closing prices at the lowest of the day. Yep, O, C, and L. If it has a longer upward shadow, it signals more of a bearish trend. So the higher this is, the more bearish it is. Okay, and when it appears at market top, is considered as a reversal signal. So you're gonna have da 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 da, and you see this. That is not a good sign if for the people that say a continuation of the uptrend towards the upside is imminent. Okay. On the contrary, it signals a possible reversal towards lower ground. Okay. And it's pretty simple to understand why. Because how to interpret this candle by itself using the 4 components we have. We have open, close, and low. Okay. So that means the price action open here. The bulls push the price action to high ground, but the bears drag the price action to lower ground at the same level that they have opened. So any gain that or an advance that was made by the bulls was eradicated by the bears within that specific time frame. Okay, bringing the price to where they see fit as being as the most appropriate, the equilibrium point, which is the open and close price, which is at the same level, coinciding with the lowest of the day. Okay, that's why it's bearish when found in an uptrend. That indicates that there is a strong seller, there's a strong wall of sellers at the top of the market awaiting to cash. Okay, to cash out. Those are people that maybe probably have open positions at the start of an uptrend, and they see that this is the end, and I want to get out of this position because of I'm expecting something bad to happen within the next few sessions. Therefore, they place their take profit orders at the top. They get executed within this range. They get out of their positions. They make money. And who is left in there are just bulls. Okay. And you can, in a sense, anticipate from there on that when people see this, when traders see this at the top of the market, that short sellers will enter the picture and drive the price action lower by shorting the specific instrument, which is going to accelerate the fall. Okay, that's why this is considered to be a bad omen. Okay, when found in market tops. Again, you need to see what the next candle will be and where it will be on the next time frame. Okay, if it's a daily chart, the next day, what's the next day is going to close at, which is what is going to give you the most accurate information of what to expect for the price action to where is the price action going to move towards to next. Okay, so hopefully you understood the importance of the gravestone doji. Let's move on to the dragonfly doji. Completely the opposite. Hopefully we're not going to spend that kind of time on this because it's self-explanatory. Open and close at the same level, which is also coinciding with the high level. The lowest point is down there. In a sense, the bears have dragged the price action to this extreme level, the lowest of the day, but the bulls entered the picture, pushed the price action to higher ground, and managed to end the session at the same level. Okay, indicates strong bullish sentiment or a big wall of buyers at that point in time. Okay, they are awaiting eagerly for the price action. They have awaited eagerly the price action to venture in this kind of territory. And they said, you know what? This area, it's a lovely place for us to buy. Okay. Therefore, they have limit orders placed within this range. When the price action falls in this range, their limit orders get triggered. They get executed. So they buy in here and they push the price action to high ground. Okay. Again, if it's found at the market bottom, this dragonfly doji is called a reversal signal. Okay. Opposite case with this. Okay. So let me do this. Okay. Okay. You see this? This is an omen. Okay. That the price action most likely is going to revert to high ground. Again, you need to see what's going to happen with the next candles, okay, for confirmation, ultimate confirmation. Okay, at the end of the day, what you need to remember that the gravestone dojis are considered to be bearish in nature, whereas if found in an uptrend, whereas if you have dragonfly dojis on downtrends, it's a bullish signal. Okay, so you can capitalize upon these two accordingly. Moving on to the next slide to wrap it up quite quickly. Hammers are found in downtrends. Is in a sense, this is a doji, but it has a little bit of a body here. Okay, so it's not either a dragonfly doji or a gravestone doji. Okay, in this kind of case. So a hammer is a type of a bullish reversal candlestick, much like dojis. Okay. Made up of just one candle found in price charts of financial assets. Now, the candle looks like a hammer, hence the name, and it has a long lower wick. This is the low. This is the low. Okay. And a short body at the top of the candlestick with little or no upper shadow. Okay. This one has, this one doesn't. Okay. So in order for a candle to be a valid hammer, most traders say the lower wick, okay, this part, okay, must be at least 2 times greater than the size of the body of the portion of the candle. Okay, so if this is out of 3s, 1/3 is like this. 1/3 responds to the real body, and 2/3 respond to the wick. Okay, so in a sense, what you need to pay attention to is, in order for it to be a valid hammer, this wick must be larger by some degree, compared to the real body. Okay, so when you see the hammer form in a downtrend, which is what we care about, it is a sign. It's not a definitive. It's not written in stone. It's a sign of a potential reversal in the market. Okay, as the long lower wick represents of a trading period where sellers were initially in control, but the buyers, okay, were able to reverse that control and drive prices back up to the close, okay, near the high of the day. Why am I keep erasing stuff? Sorry, guys. So again, hammer, bada, 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 bada. And you need to have a long shadow. This is on a downtrend, okay? You find this candle down there, indication or a sign for a possible reversal. Again, is only a sign. It's not definitive. Please digest this, okay? Because many people just jump onto this kind of not that sophisticated approaches of looking at these candles, finding these candles and saying, oh, you know what, definitely it's going to rebound to high ground, but they don't wait for the confirmation and they get, they say, I'm going to buy in here, and the price action goes from there onwards downwards. It can happen, okay? So why not wait for the next candle to arise to get the confirmation, or the next two, and then enter the market with much more confidence? Obviously, you're going to leave a little bit more money on the table, but still you're going to be much more confident that you're going to make money on the upside, and that was an actual pivot point, an actual reversal, okay? So it's highly suggested. So after seeing this chart pattern form in the market, most traders will wait for the next period to open higher, okay, than the close. So this is the open, this is the close. So in the next candle needs to open something like this. So above the open ideally, or above the prior day's closing. Okay, this is your confirmation. Okay, some people like 2 days, some people like 1 day, 1 period, meaning afterwards. So if it's a 1 minute chart, it's going to be the next minute. You understand what I'm saying? If it's a weekly chart, it's going to be the next weekly candle. Or if it's 30 minutes, it's going to be the next half an hour. Okay, you get the point. So 2 additional things that traders will look for to place more significance on the pattern are long lower wick, but also an increase in volume. In the next webinars, I can't remember exactly which one it will be, we're going to do a deep dive on the aspect of volume. Okay, super critical. It comes as in secondary kind of nature in trading, but it's super important. Not only price action and candlesticks and all that kind of stuff. We need to see the volume flowing in or out of a specific instrument for better understanding of what is going on in the market. Okay, so please tune in for the volume kind of presentation we will have. I can't remember exactly what it is, but it's going to be in the near future. Okay, super informative. Now, shooting star is obviously the opposite of the hammer. Okay, pretty much, if you remember what we just mentioned in this slide and you flip it on its head, is what you get with the shooting star. Okay, so let's go quickly and briefly above it. So shooting star is a type of a bearish reversal pattern. The prior one was a bullish one. The shooting star looks exactly the same as the inverted hammer, okay? But instead of being found in a downtrend, it's found in an uptrend, which has much more significance, and thus has different implications. Like the inverted hammer, it is made up of a candle with a small lower body, or no lower wick, and a longer upper wick. So this, once again, has to be larger than this. But ideally it's going to be at least 2 times larger than that. It's going to be found on the bottom, okay, on the top of the price action, okay, so because it's a bearish reversal, okay. Once you see this and you see the next candle being down here, confirmation that it's going to be a reversal, okay. So 2 times higher than the size of the lower body is what most traders look at. Fair enough. So the long upper wick of the candlestick pattern indicates that the buyers drove prices up at some point during the period with a candle, which the candle was formed, but encounter strong selling pressure, which drove prices back down for the period to close near where they have opened. Okay, so Bulls are eager to push prices to higher ground. They see a wall of sellers, okay, on the opposite side, triggering their buys. Sellers are exiting the market, pushing prices to lower ground, and then you have short sellers as well, aggravating the fall afterwards, okay? Identifying this is as a reversal point, okay? So when encountering this, remember, before we go on, as this occurred in an uptrend, okay, hence this example, the selling pressure is seen as a potential. I have to underscore the potential, and then I'm going to move on. Potential for a reversal signal is not written in stone. Digest this, please. Okay. So when encountering this pattern, traders will look for a lower open in the next period before considering the pattern valid and potentially including it in their own strategy. Okay. Pretty much covered this. So let's quickly go over complex candlestick patterns and we will be done. Okay. Give me 1 second, guys. We'll have a question. Where exactly on your website, client portal, these webinar clips save, please? Let me get back to you, Elias, because for the time being, I cannot recall the whole path in my head. We're going to do this near the end of the session, or I can actually send you an email with screenshot where you can do this exactly. Okay. So give me 1 second to finish this and we will address the question. Okay. So, oh, by the way, you can see these kind of webinars on the company's Twitter feed, or now X, whatever that is. On the LinkedIn profile as well, on the Facebook, the guys are uploading these webinars as well. It's going to be attached on the daily commentary segment that we do. I do a daily, let's just say, brief, okay, of what has happened and what is expected to happen within the markets. With the stuff we are actually teaching here on a daily basis, you can get updates on what has happened, for example, with central banks, with stock markets, with prices of gold, of crude oil, and all that kind of stuff. You can find that on a daily presentation that is going on social media. And after that, if you tune in for that live environment, because I'm doing it live, you can see past webinars being played afterwards. Okay. So that's another source of you for you in order to go over the past webinars if we cannot find the actual path, which I'm pretty sure we will. Okay, so let's finish with the session, guys. So we have complex candlestick patterns. This is what we call the bearish 3 method. This is what this kind of formation is called, 3 method. Primarily 3 method is in regards to this. Okay. So it has, in a sense, a long black body, meaning a red candle, so a bearish candle. So this is a bearish candle. Okay. Followed by 3 small bodies, green candles, 1, 2, 3. Okay. Open is here, close is here, open is here, close is here. You get the point. Whereas open price was up there and close price was there. This is bearish. That and this one are bullish candles. Okay. So you have one big red candle. Okay. This one. So a bearish candle, and then you follow then 3 small green candles or bullish candles follow 1, 2, 3. But look at this, they do not exceed the first bearish candles range. So they are trading within it, okay, if you like, within the open and the close levels of this kind of candle. Okay, this is what we call the bearish 3 method formation, which is bearish, okay, and it's bearish continuation part. Okay, so once you see this red candle being formed, big one has big real body, 3 small bullish candles that do not exceed the bounds of the open and close of these big red candle. Okay, and you see a follow-up of big red candle. Okay, you have a high degree of chance of spotting a the bearish 3 method formation, which is bearish. Therefore, you can short the position here, capitalize on the fall. Okay, so it has, let me briefly summarize this, has a long red body followed by 3 green small bodies. Okay, and the 3 white bodies or the 3 green bodies are contained within the range of the first black body or the red body. Okay, so consider a bearish continuation pattern, and we will see continuation patterns in the next webinar, more specifically chart patterns in general. Okay, now the opposite of the bearish 3 method formation is the bullish. Okay, completely utterly the opposite. So green candle, so bullish candle, open price here, close price here, followed by 1, 2, 3 small bodied red candles, or black in this kind of case, that do not exceed the trading range of this candle, the bullish one. Okay, followed by a surge of price action with a big bullish candle is what we call a bullish continuation pattern, which is the 3 method formation. Okay, completely the opposite to this. Those are the rules, however, you have to remember. Big real body, in this kind of case, bullish. Okay, 3 following small bodied red candles, bearish candles, followed by a big real body bullish candle. Okay, so continuation towards the upside, you can go long here. Okay, purely using candlesticks for trading without adding all the other stuff, again, which is not advised. What else do we have here? Okay, this one is called the 3 black crows. No wonder why. Black, due to the fact that in the past we used to color candles in black and white. Black represents bearish candles. Okay, so you can find now what we call the 3 red crows, but red crows does not make any sort of sense, so that's why we still use the terminology of 3 black crows. Okay, so it consists of 3 long black candlesticks, okay, bearish candlesticks with consecutively lower closes: open, close, open, close, open, close. Okay, so you see a bearish sentiment or the bearish movement is sufficiently strong because of the sequential, okay, lower closes. Oh, I should have, excuse me, should have connected this instead of the opens, okay, the closes. So the top prices are near or to at their former day's highs. So when it appears at the top, is considered as a reversal. Okay, so not a continuation. This is a reversal if and only if it is found at the top of an uptrend. Okay, next one is obviously the complete opposite. 3 white soldiers. You get the point with the white and black. Once again, in the past, white candles were the bullish ones, black candles were the bearish ones. So here we have 3 bullish candles with big real bodies, okay, full bodies. You see, okay, consecutively higher highs. Okay, so we have here open price, close price, open price, close price, open price, close price. Okay, so sequential higher closing prices. If is this found in a bearish, not bearish, but in a downwards moving market, it serves as a bottom reversal signal. Okay? Pretty self-explanatory. You're doing this in a sense. Okay? So 3 long white candlesticks with consecutively higher closes. Closing prices are near to or at their highs. When it appears at the bottom, is interpreted as a bottom reversal signal. Okay? Let me see what we have. Okay, final slide we're going to do today. Final 2 slides. So of the same thing, of the same aspect. It's going to be about what we call the morning star candlestick formation. Okay, so this is one of the iconic, okay, chart patterns, so chart candlestick chart patterns that traders specifically look at, because it has the highest chance of, if it's formed correctly, has the highest chance of giving you the highest probability of placing a lovely trade and capitalizing on their reversal. Okay, spoiler alert is a reversal formation, candlestick formation. Okay, so the morning star is a pattern seen in a candlestick chart, a type of chart used by technical analysts to describe, predict. Yeah, okay. No need to do that. We've done this a million times. So the pattern is made up of 3 candles. These are the components. Okay. So you normally have a long bearish candle. So this is the one I'm talking about here. Followed by a short bullish or bearish doji. Okay. So remember dojis. Okay. Bullish, bearish candle, a doji, and then followed by a bullish candle. Okay, so which is followed by a long bullish candle. Okay, so in order to have a valid, I'm gonna underscore this and I'm gonna paint it whatever color is out there. In order to be valid, okay, in order for Morningstar pattern formation to be valid, most traders will look for the top of the 3rd candle to be at least halfway up the body of the 1st candle in the pattern. This is what we care about. Okay? Seeing the long red candle or the bearish candle form, perfect. Seeing the doji being formed at the bottom, awesome. That's a signal that we might see a reversal. The confirmation for us is when, excuse me, you see the 3rd component of this pattern, which is the bullish candle at the end, okay, being formed and rising at least, okay, halfway on the prior bearish candles trading range. Okay, so you need to have at least, you need to have a big bullish candle that surpasses at least the halfway point of the bearish candle that initiated this Morningstar pattern formation in order for it to be valid. Okay, keep this in mind. If you have this, okay, bearish candle, doji, and then you have this. This is not a Morningstar pattern. Okay, this needs to be at least as half. Okay, if that does not mean is not valid. If the next entirely valid, I mean, this does not mean it shall be discarded as quickly. Actually, nicely put. Okay, if the next candle does this, then you have a confirmation. Okay, but in order for this to be branded as a Morningstar pattern formation, you need to have all these parameters match these descriptions. Okay, so you have a large down candle representing selling acceleration. Okay, you have a doji representing indecision, primary nature of dojis, and then you have a long white candle representing buyers taking control. This is the complete reversal, okay, formation or downward reversal pattern of a Morningstar, which we call Morningstar. Okay, so black candles, as a side note, indicates falling prices, while the white candles indicate rising prices, obviously. Okay, so interpretation. What information does it tell us? Okay, let's create this story. okay, in order for you to remember how this whole thing comes together and why it tells you what it tells you, okay, why does it mean and why it is important, okay? So when you found in a downtrend, this pattern can be an indication that a reversal in the price trend is going to take place. Why? Okay, what the pattern represents from a supply and demand. Please learn how to conceptualize this using basic economic terms, supply and demand, okay? The cornerstones, the cornerstones of economics in general, supply and demand, is that we see a lot of selling in the period which, in a sense, forms the first black candle. Okay, no doubt about this. Strong selling pressures. Remember what we said about the larger the size of the real body is, the more important it is. This is what we have here. So it signals a lot of selling pressure, okay, or a lot of selling action taking place. Then a period of lower trading, talking about the doji. Remember, it's an indication of indecision, where we see this kind of hold, okay? Remember the analogy I just gave you, not just, but the analogy I gave you with the tug of war, the rope between bulls and bears that they pull at each of every side, okay? And by the end of that specific period, they have gone, nobody has gained ground. This is what the doji is here. The doji is indicating you lower trading, but with a reduced range, which indicates indecision in the market. And this forms the second candle, the doji, which is then followed by a large white candle, which, remember what we talked about, bullish candles representing buyers taking control of the market. Okay, a lot of buying demand is in there. Okay, the larger the real body is of the bullish candle, the more important and more significant it is. Okay, that's why I told you you don't want to see something like this after 1, 2, and then 3. You don't need to see that. You need to see a big green candle covering at least halfway of the red candle. Okay, so as the morning star is a 3 candlestick chart pattern, traders oftentimes will not wait for confirmation from a 4th candle. I don't like this. Before buying, you can brush, but still, what I'm gonna give to these kind of traders that jump onto these kind of positions in here is if and only if you see rising of volumes. Okay, if you get the confirmation on the bottom of your chart that the volumes are actually spiking, okay, validating, okay, this intense bullish pressure in the market, then yes, 1, 2, 3, place a long position and watch the price action moving to higher ground. But that is only if and only if you get the complete, okay, formation, proper formation of the morning star pattern formation accompanied with volume. That's the only scenario where, from my point of view, my own humble opinion, this can be used as with the most degree of confidence. Okay, so traders will often look at the size of the candles for an indication of the size of a potential reversal. Now, the larger these candles are, okay, meaning 1 and numero 2, this one, okay, obviously not the doji. Doji is going to be flat. You need that doji to be flat, okay? The larger these 2 candles are, the stronger the signal for a reversal is, okay? And leaves you with extrapolating that the larger the potential reversal will be, okay? So the faster the price action is going to surge from there onwards, if this is formed correctly, the faster the prices will rise from there onwards, and you will have you're going to be in bank, quote unquote, bank territory soon after you get a long position in there. Okay, so I think this brings us to the end of today's session, guys. We have done a lot. We have gone way past our time. Apologies for this, but this stuff happens. This was due to the unfortunate event that we had last week where my PC just froze on its tracks, and we had to abandon this kind of webinar we've done with fundamental analysis. This webinar, we've covered what we have left off, and then we've added some with the technical indications, with technical indicator, or with technical analysis, where we went over candlesticks, and more specifically today with a brief introduction. Next webinar, we're going to stick with candlesticks, and we're going to do patterns in general. So we're going to do the head and shoulders, the double tops, double bottoms, how to spot them, what kind of information are they conveying, how to use them to your advantage, okay? And make money. For the time being, enough of me about blabbering. We've reached nearly a 2-hour mark. Hopefully, I have not bored you. I have not bored you, okay? So we have to leave it here. Elias, I'm gonna have to look at your request at my own time. Hopefully, I'm gonna send you. Thanks for your kind words. What I would like from you, Elias, is please can you send me an email, okay? Please write this down on webinars@t4trade.com. This is the email. I want you to just send me an email saying hi or something. And I will respond to you with the path of where you can find these webinars, okay? In order for me to have your email, in order to contact you. That's the reason why I'm asking you for you to send me an email on that address, okay? So I will see where exactly the guys of the media team have put these kind of webinars for you to go on and watch for your own, at your own time, for your own, at your own discretion, and all that kind of stuff, okay? So please send me an email. I will do my best to answer you as quickly as possible. For the time being, thanks for everybody for watching. We'll catch you on to next week for a next session. Okay, take care. Bye-bye. Have a good, lovely weekend.